On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. It's been a good year for the local share market. The NZX 50 index is up 11% so far, which puts it on track for its best year in 4. Most of our biggest companies have performed very well, but one notable exception is Spark. Its share price is down more than 40% in 2024, which makes it one of the biggest decliners across the entire exchange. There are several reasons for this disappointing performance, and some of them rest squarely with the management team and the board. The New Zealand economy has been in recession for 2 years now on a per capita basis, and that's what matters for most of us. Against that backdrop, investors had expected a company like Spark to be a solid performer. After all, it was seen as a stable, consistent business with a reliable dividend and only limited sensitivity to the state of the economy. We call that sort of stock a defensive one. Many of us got that wrong, with Spark running into more headwinds than expected. The company obviously underestimated those challenges too. It reduced its earnings guidance back in May, but then it missed the bottom of that estimated range when the result was reported just a few months later in August. While it was only a minor shortfall, investors don't like to see relatively predictable businesses missing guidance, especially just a few months after providing it. Since then, Spark has cut its 2025 dividend guidance even further, although some analysts believe it might not have gone far enough. Another challenge facing the business is the fact that it has too much debt. In 2022, Spark sold 70% of its mobile tower business for $900 million to a Canadian investment fund, the Ontario Teachers' Pension Plan. It chose to return a good chunk of that money to shareholders by way of an on-market share buyback, and it started that early last year. In hindsight, the conservative option would have been to hang on to this capital. With the share price languishing at a near decade low of under $3 now, the board looks a little foolish for buying back a whole heap of shares above $5. This has put the balance sheet under pressure too, with debt now above Spark's own targets. The company intends to sell its remaining stake in the tower business, and it will need to explore other options to fund its growth ambitions. All of this culminated in Spark being removed from a key global index last month, which led to an additional wave of selling from funds that follow this benchmark. Unsurprisingly, the board and the leadership team haven't endeared themselves to the investment community over this period. The lack of engagement from senior management has also been very disappointing. You don't need to be a PR genius to figure out how to respond to a crisis. And trust me, a 40% plus share price decline from a defensive telco in just 12 months is the stock market equivalent of a crisis. You take responsibility, you make sure you're transparent and accountable, and you do your best to get ahead of the story. For listed companies, front-footing it with shareholders is also crucial. Now, Spark isn't one of our biggest holdings, but our clients still collectively own 3 to 4% of the company, which is a lot. And from our perspective, Spark didn't follow those simple rules very well at all. They didn't treat their shareholders' capital with the respect it deserves, and they didn't front up. It might not return to its former glory anytime soon, but that doesn't mean it doesn't look reasonable value right now. Despite getting belted all year, the stock is still paying an annual dividend of 25 cents, with partial imputation tax credits on top of that. So at about $3 a share, that's a gross dividend yield that's easily in double digits, above 10%. And even if we do see a little bit more further slippage, many investors would argue that all of the bad news, and probably more, is in the price right now. However, it's a long road back to $5, and the company has a mountain to climb if it wants to earn back its credibility with its existing shareholders.
For more insights, visit craigsip.com.